Hi, I'm Owen, the host of the Australian Finance Podcast. This podcast is proudly sponsored by BetaShares, one of the leading providers of ETFs here in Australia. Serving thousands of financial advisors and over 1 million investors, BetaShares manages tens of billions of dollars on behalf of investors right across the country. I'm proud to partner with BetaShares on the Australian Finance Podcast, Australia's premier financial podcast, because there is great alignment in the long-term philosophy shared by both businesses. I hope you enjoyed this episode of the Australian Finance Podcast. Gemma Mitchell, welcome to this episode of the Australian Finance Podcast. How are you?
I'm really good, thank you.
Pretty good.
For those watching on YouTube, you'll see that we're matching, and it was totally unplanned.
We are.
We have the same sweater on.
Yes, we do actually. I think you wear it better for what it's worth. Although I did get some compliments yesterday, so.
You got compliments?
Yeah, so I worked this second day in a row.
Oh, yeah. So you got the compliments, so then you decided you're going to just keep doing it.
Just keep doing what works. Isn't that the old trick?
I think that's...
There's so many things in life. If it's good,
yeah,
why ruin a good thing? I probably will ruin this good thing, let's be honest. But no, it's good to have you here recording in Melbourne. So we've got questions. We've got questions about divorce. We've got a question about leave entitlements. We've got questions about separations generally. We've got a wonderful name of a questioner this week, which is Newbie Numbnut. Which would take the cake as one of the funniest names we've had in the recent times, although we've had some crackers. So if you do like to have your question read out in the show, or just a bit of feedback, or you've got a bit of a rant, maybe it's a money hack, maybe it's whatever, send it in to us, care of the podcast, the inside your podcast player there, you'll find a link that says ask a question. You can use that for feedback, a bit of fun, a bit of banter, whatever. Gemma and I answer questions every week. Before we get to that, I thought a question that I should ask you is I don't think, because I've never asked you this, what is your best ever investment?
Yes, so my automatic, my first thought is property, but I should probably actually say my career, like my ability to earn income is the decisions I made in my career, my investment in myself is probably up there. But from just if we're looking at like other assets, definitely property.
Okay, but you've got two lessons from this.
I do.
And two stories, if you will.
I do. So I bought a property, a mortgagee,
like the bank was selling it on behalf of someone.
Yeah. So I bought that, and I got that for probably 50% what it was, and there was nobody else at the auction. And so I still have that property today, and the capital gain on it has been amazing because the minute I bought it. So that's been really, really good. But it's not a great investment from a holding perspective because it's a townhouse. It's got body corporate. It's really expensive. It's really old. It served a purpose at the time, but now I've just kept it because it's a good a backup, like security. If I was couldn't live where I rent, I could live there. But it doesn't make a good cash flow plan.
Okay.
But it serves a purpose, and not all assets have to tick all the boxes, right? They can be lifestyle but it's been a really good investment. And then the other one that I was telling you about before is me and my ex-husband sold a property just before COVID. And then pretty much COVID happened, and in our town, everything felt like it doubled overnight. The new people got it valued, and it was double. And it was actually across the road from our other house. So we had to look at it every day, and he would remind me that it had doubled in value from when I had decided we were going to sell it. But really importantly, I tell myself this so I sleep at night. We were very happy with the price we got. We did not have a crystal ball that we could see what was going to happen in the market. It could have gone the absolute other way. And it served a purpose. Like, we were happy with that price. It allowed us to do the next things, renovate, travel, get our debt at a comfortable level. So we did the best we could with the knowledge. We were very, very happy with it. If we had a crystal ball, that would have been amazing. But either way, property and career, best investments. What about yours?
No, those are really interesting. I've got a follow-up question, which is and a comment. The comment is that people listening to this is probably like, they're probably like what goes around comes around, because on the one hand you bought one for 50% what it was worth, and on the other hand you sold one for 50% of what it was worth. So
yeah, true. I've just evened out.
Yeah, that's it.
And
Well,
and then I went through a divorce. So
there's some questions about this here. So so it's really interesting, those lessons. My question was going to be, for anyone that's not familiar, like you mentioned kind of just offhand that it was like a bank sale basically, and you were the only one there. For most people listening, they'd be like, what is that? That sounds incredible. So what is that?
So it's a mortgagee, so it's been repossessed because the person couldn't pay the mortgage, and the bank is selling it, trying to recoup as much money as possible. So it was through a standard real estate agent. We didn't actually know. We were interested in this property because we needed something for my mother-in-law to live in, and she was at an age where she didn't have the assets and she didn't have a borrowing capacity. So we were like, we'll buy something. And then she can live in it. So we were just looking at normal kind of townhouses and things, and didn't know that it was a mortgagee sale until we'd looked at it a few times, and then they do different kind of disclosures. And it goes to auction, which is very, like, a lot of people can't buy under auction conditions.
Auction rules,
like that. So that was we were very nervous about that. Definitely don't recommend buying under auction conditions just with a pre-approval, which is we did and risked. But yeah, it means that the bank is trying to recoup, and if they don't get like enough for it, there's potentially then the owners that are still going to have extra to pay off it.
So if the bank doesn't recoup its loan value, basically.
Yeah, then the person can still be liable for the difference. But it's a very different set of terms and conditions, and it was all very nerve-wracking to like buy a property like that. There were squatters in the house, had to get the locks changed straight away. It was in very bad condition, but it turned out to be like a great investment because we had the skills to be able to fix all the stuff. Like my husband was a builder, so so definitely not for everybody, but it definitely propelled our like property and wealth journey.
Yeah. Interesting. Can I one final question, because I don't think that they're as common these days as they once were.
They're
when
really
was
hard
that?
to find. This would have been in 2000 and I'm going to say 12-ish.
Okay.
And I kind of feel like they were popping up everywhere there, and like people used to talk about getting lists of like online of them, but I never hear of them anymore.
I feel like it doesn't happen anymore because property prices, the bank's just like, you got to sell it, and then the person's like, I'll sell it.
Yeah. I'm on a list. I get emails from the public trustee for estate properties, but I've never really looked at it enough to see like, are they market rates? Are they a good deal? But I'm just like, I just get some notifications. But yeah, that's a public trustee. Queensland that do stuff like that, estate sales, but that's different to a mortgagee, but I guess it's in the similar kind of vein. Yeah,
there's a seller that's maybe not
a very motivated, or the public trustee is selling it on behalf of an estate that's
passed away.
Yeah, and there might be no family or...
Yeah, right, well. So I'll be quick. Mine would... You can take it a few different ways, but obviously career is really important. As you said, I think that's important to double click on, is like investing in things like my education. I'm very grateful for that now. Very, very grateful, because I think there's a lot of assumed knowledge that I have, but I see it's absent in some people, in a lot of people. And I've been very privileged, obviously, to work at some great places and acquire knowledge that way. But definitely through like traditional learning I've got a huge text bill, but I think that's something that kind of worries me about the next era of technology, is people won't really apply themselves as much because they can get around things like AI and that these days. So I'm very grateful that I took the time and persevered, and because that led probably to the most valuable thing that we own, which is the business. So the business wouldn't exist if it wasn't for that commitment to study and all that sort of stuff. So that would probably be the biggest one. In terms of percentages, and like I think maybe my property already is like the biggest dollar value individual type decision, but it's hard because we put so much into it and we pay interest. So if anyone was really honest with themselves, like there's probably let's wash a little bit off of that gain, but it would definitely be like stocks. Like I still own shares in a company called Pro Medicus. I actually did a quick calculation the other day. Had I not sold my shares, and I didn't put that much in it to begin with, like it would be, I think it was more than what I'd made in the property. And it was only from like a few $1,000s of shares. So like it was a good size position, but
you sold those.
No, I still own more than half of what I had. But when it goes up like 30 or 40 times, it's pretty good.
Yeah.
So that was one of many of really interesting companies that we managed to buy and hold. But that would be at Pro Medicus. Still own shares. It's not a recommendation. It's just you can go and look it up. We talk about it on the Investors Podcast a lot. So we have a lot of good questions here. There's one that's got like a big two-parter, and we love to hear your questions. So write into us via the link in your podcast player in the YouTube description. Just remember that we don't know your needs, goals, or objectives. Keep the name funny so it's a bit of entertainment for everyone. And also don't act on the information you hear on a Rask podcast until you've spoken to your financial planner. Because we don't know your needs, goals, or objectives, we don't know if the information is appropriate to you. And as always, before you invest in something or acquire a financial product, as we say, like when you get like a super fund or an insurance contract or something, be sure to read the product disclosure statement or PDS. So this first question is a two-parter. No uni, no worries. So it kind of flies in the face of what I just said.
So some context. This was a very big question that I've pulled out parts. They worked for a uni for like 20 years and now they've left the uni. So that's why.
Okay, so it's not the uni education, it's the uni job.
The job. Yeah.
Okay, gotcha. So I have approximately $20,000 worth of leave entitlements that will need to be paid out from my previous employer once I terminate my permanency. This is a majority long service leave with some annual leave as well. When would be the best time to do this? / is there any tax loophole as this payout would occur as my second income? ? The payout would jump my annual wage for the financial year to approximately $110,000. Gem?
So this is a big consideration. So when you see a financial advisor for retirement planning, this, like if you've got any outstanding leave and things, that's a big consideration in strategies because there's different ways that you can take your leave and you generally have more flexibility at retirement if you're not going to another job, which this person's going to another job. So the two ways that you would consider it if it was for retirement planning, it's if you want the lump sum and then that's timing on tax year, if you can push it into a brand new tax year where you're potentially not going to work, that's going to help your tax. But when you get leave paid out as a lump sum, they don't have to pay superannuation on top of it. So you are literally getting 11.5% less, soon to be 12.
Yep.
Obviously that's been accumulating and we don't know the time frame and things. So if it's going to be a lump sum, you want to time it around like the time of year. So getting it paid out in June when you've just worked 12 months is going to be a much bigger tax consequence than if it's in a brand new financial year and you potentially don't work or your salary is not the same. So tax planning is very, very important. But yeah, considering so in the retirement example, you could take it as a lump sum, you'll forfeit superannuation. The other alternative, if you're not going to be going to another job, is you could potentially take it as leave if work lets you. So you just keep getting a salary. On that, you're accruing more leave at the time. You've still got access to sick leave. You're getting paid superannuation and you're potentially smoothing out the tax as well.
That's great.
But I don't think this person is going to have that option because they're going to another job. So they can't take long service leave and have it all paid out. So they're going to have to really work out the tax in the year. If their salary is going to be similar, it won't matter, between the different years. Tax loopholes, obviously you want to talk to your accountant and get advice, but this might be where, depending on their super balance, they put a contribution into super and claim a tax deduction. Yeah. So they convert it from a personal to a pre-tax. Yeah. That's the type of stuff that I'm thinking, but I think they should definitely get advice. Depending on how long they've been building up this leave, I think the dates also matter.
Yeah, okay. I don't know.
It's something around 1993 3 or something.
Okay.
There's like a date if it's pre or post that, I think that changes it. So I would be talking to work, getting all the details on what's actually going to be paid out, dates, all of that kind of stuff, and talking to an accountant.
Okay, that's good. I actually spoke to a fellow last night who's got, what did he have? I think it was equivalent of, was it 11 months worth of all leaves put together, because he'd been with the organisation over 20 years.
Yeah.
And he's coming into retirement, so he's going to take a long period of leave.
Mm-hmm.
And then when he comes back, he's either going to go part-time, he's going to technically retire, go part-time into a job, or just completely walk away. And it was a huge part of the retirement because it effectively can cover oftentimes one of the most expensive parts of retirement, which is the first year when you're like, hooray, let's go to Europe,
And you step back from work, but you've still got that guaranteed income. So it's not such a scary, like it can be a nice transition. And some people are allowed to take it at half pay. Like there's lots of different things that you can do. I have seen some employers not allow people to do it because like a lot of the time they can't fill those roles. Like, so you need to talk to your work about it. I've also seen people, like we've given advice and been like, we recommend you take it as leave. And they've gone, I don't want to do that to my employer. I know that I'll be better off. But so there's lots and lots of considerations. But I think this person won't have many choices. It'll be how they navigate being tax effective once it's paid out.
Good to know. No uni, no worries. Also says, I have had to take out a new super fund.
So this is for their new job.
New job. The old super fund is a government fund. My new fund needs a minimum of $6,000 for the insurance to kick in. Should I deposit $6,000 to get those benefits if required? Should I move everything across into one fund? So there's a lot of general advice wisdom here. Mm-hmm. The $6,000 is only a recent thing to try and avoid everyone's super getting soaked up by insurance. But what do you think?
So I think this person might be misunderstanding and they need to talk to their fund. So I'm not going to answer if they should be doing any of this, but I think that they're misunderstanding because as far as I'm aware, most super funds, once one contribution goes in, the insurance will get set up. Because
unless they opt out.
You can opt in. So there's like a tick box. You can tell the fund, and that means that if the balance is under 6,000 or it drops at some point in the future, that the insurance keeps going. And there might be an expiry on the opt-in. Like you might have to do it every so often. But they can talk to their fund. It's not a hard and fast rule that there has to be 6,000 in there, as far as I'm aware. You can opt in so that from contribution 1, you've potentially got that default cover. The other thing is if you don't want to get the default cover, you could apply for cover, you could go retail cover, you could go and get insurance with, we use Sky Wealth here.
You get it from anyone,
Yeah, and then have it linked to your super or pay it outside. Like there's so many different options, but I don't think they need to put 6,000 in if that's the only reason that they're trying to do it. There'll be lots of different ways to get around that. It's just about making sure you understand the rules and are making an informed decision on what's right. They've said, should they move everything into one fund? Being a old government super fund, they haven't said which type of fund, but potentially that fund's got benefits that a standard one, like this new one, won't have. So and maybe they won't, sometimes there's restrictions on moving them. So without getting advice and there's just way too much there. So I would be encouraging them to talk to their new fund and their old one and what are the features and benefits I'll lose? Can I even move it? What's the benefit? And those super funds will give you information on those funds, but they potentially won't tell you if you're better off to go to the other.
Yeah.
They'll just be kind of like silos on that fund. But they should be able to give you enough information each that you can make an informed decision or decide, no, I actually need a financial advisor to help me with this.
Some of those government funds are really good in some ways. Like
some of them, it might be a defined benefit.
That's what I'm thinking.
And if they're under 55, it might be going to a deferred benefit and sit there in a protected kind of, it goes up with a calculation rather than investment returns. So some of them don't have contribution caps. You know how we're subject to 30,000? Potentially it's one of them that,
Is it a bit weird that they feel like they have to leave? So they have to take out a new super fund. Is that because...
See, this government fund might not accept contributions to non-government roles. So there's so many different
Right.
restrictions, and it really depends on which
like,
fund it is.
I had like military super long after I left, right? It was only a small amount, but like that would still sit in there. So
but do they accept contributions?
Well, that's a good question. I can't remember.
Yeah,
But like those,
they're also
different. Nuanced.
Yeah.
Yeah, right. But seriously, get advice on this if you're unsure, because you may be giving up something you do not want to give up, and you can have two super funds.
Yeah, and like we talk about, most of the time the double up is in the admin fee, which might only be $50 to $100 a year. But if you've got significant benefits, you might think that that's totally fine to pay. The other thing you don't want to double up on is insurance, because that'll be eating away at your retirement savings. So you want to make sure that you're not paying for cover you don't need.
And by that, Gemma, doesn't mean cancel the insurance. Like, go and look at it first, because you might not get the same level of cover. It might be worse than the new one. So just have a look at both. Adam says, that's surely not his real name. I walked away with around $110,000, there's a lot of zeros there, $110,000 from selling the family home after a separation. I've got 2 kids and no debts, and feel like I'm priced out of buying another home as a single parent, so I'm looking for advice on how to best use my money. So first of all, get advice, like formal advice. Even if it's, just once-off advice, strategic advice would be very valuable to you, Adam. We deal with people from every walk of life, whether they're man or woman, kids, no kids, before separation or after separation, you can get advice. So we're going to speak generally about life after separation. There's other stuff on this in a moment. But Gemma, I guess the generalized question of this would be, I've come away, do I buy a home? That's a big question. I've got reduced borrowing power. Now it's one person with dependents, so the bank sees me as figuratively earning less.
Yeah.
Thoughts?
This is a really common one. This like description of their position I hear all the time, and people feeling the same, like they're totally priced out of getting back into the market. So with this person, absolutely, I'd want them to see a financial advisor, and the types of things that they'd be looking at is like, well, what are your goals? Like, is home ownership really important to you? Are you close to being, getting back into the market? What does your cash flow look like? Because there's all of those different incentives to get into like a 2% deposit, a 5%. So you could be talking to a financial advisor about your goals and what this money could do if it doesn't look like a property. You could be talking to a mortgage broker and going, am I eligible for any of these? And then assessing, that's never going to work. Like, so for example, if it's, you have to have, like, the house might be under 750 or something in some states.
Yep.
And you might go, well, where I live, that's never going to happen. So you've just ruled out that, and you go, right, well, now I know at least one thing's off the cards. Like, I tend to see people discount options before they've really looked into them. So I would encourage them to get really clear on their goals and what passes their sleep at night test, if they want to be homeowners or if they're just okay with going, no, it's not for me, I want the next best wealth creation strategy, then actually investigating, like, is that ruled out, or do I feel like it is? If it's not ruled out completely, how far away could it be? Because, if this 110 could sit in a savings account and they can add 20 or 50,000 to it, maybe they'll be able to get that house in 2 years, and then you wouldn't want to be investing it.
No.
There's so much. And then, it might be that they are a rent investor and they use that money for property. Yeah, but it doesn't necessarily have to be where they live. It's that's a substantial amount to do, like, to start building wealth from. Like, they're going to be feeling like they're starting from scratch. Like, but that's
great.
It's significant. They're going to have lots of options, but it'll come down to their goals. Yeah,
it's one of the things that people who aren't in this situation probably don't appreciate is when you've got kids and you separate, that you might not be able to move. So you might not be able to move to a cheaper suburb to live there, because there may be, the kids need to go to school. There are school zoning restrictions. You also need to be within distance of whatever.
Yeah, just logistics going between two houses and things like it.
It's a real thing.
Makes
so
it difficult.
If you're the type of person that feels like you want to own a property. The idea of rent vesting is very effective and at kind of like calming that feeling, because it does give you options when the kids are older and maybe you can move to it or something like that. It can also be tax effective. It can open the door to things like debt recycling and things that you can pursue in 5 or 10 years because you've got an asset that's grown and there's equity inside it. So there's so many things you can do. And I just don't want anyone to feel that listens to the show that just because you don't own a home that you're not capable of making your money work, because there are so many amazing options out there.
And I think that's it. Like, people get stuck on, I saw my parents or the people around me build wealth because they owned their home and they paid it off. And then if we don't feel like that strategy is accessible to us, it can feel like you've got no options. But there are lots of different things that you can do. And flexibility, I think, is going to be really, really important. So like, I'm renting right now because I got divorced, and I don't know what my family situation is going to look like in 2 or 5 years. You know, if I bought a house that suits me right now, maybe it's not going to suit if I get a partner and they've got 1,000 kids, like, I don't know what life's going to look like. So I think having things that are working towards like goals of building wealth so that you have options when you know what life might look like down the track is really, really important. Yeah,
just having that kind of optionality. Yeah. So we'll come back to divorce in just a second. But newbie numbnut wrote in and said, "Hi, I'm a newbie numbnut here." Newbie. I keep getting it wrong. I just wanted to start off small and tried to invest on Perla with $50. It just laughed at me. Which ones can you start small till you gain confidence? So this is a great question. Obviously, a bit of fun.
And they've put a laughing face emoji in there. So we're laughing with them, not at them.
Yes. We've all made these types of small mistakes with things. You're probably using Perla, regular Perla, which is the $500 minimum. The other one is Perla Micro.
Yeah.
So Perla Micros means like micro investing, start with smaller amounts. I don't think you even need $50. But a lot of them like that, like Raise, Beta Shares Direct, Sharesies.
Yeah. Yeah, so there's two different, so there's a standard kind of brokerage platform that'll have your minimums, and you usually pay a brokerage fee. And then there's micro investing, which is, do a couple of bucks or, upwards, and it's a lot more accessible. So yes, I think that they've probably just used
the wrong side of Perla.
Yeah.
But that doesn't mean that you're definitely on the right track of starting small. So just keep persevering, and good on you for asking a question and making us laugh. That means you'll get either a membership to Rask or the Value Investor Program for free if you write into us. Anyone who asks a question can get the Value Investor Program for free, normally $499 on our website, or a membership if you already have the course or you don't want it. So just write into us. It's yours for free.
And if you can send in tongue twister names like that so Owen struggles through them, again, that would be great.
I think I had another one in the last episode. There was something about Drew. I don't know. I'm off my game. It must be this sweater. It's the colour. Or maybe it's the fact I've been working 14-hour days for the last 3 weeks.
I think it might be.
Need to be brave says, I'm 47 and divorced. While married, I was financially controlled in so much that I didn't even know how to pay a bill when I left. I have had a super steep learning curve in the last 3 years and want to start investing about $500 a month into ETFs. Should I get a financial advisor to help me choose an ETF? I'm very scared to make big decisions. If so, how do I find a financial advisor I can trust? That's a lot in that.
That's a lot.
So same rules apply to Adam's question about life after separation, in that you can feel a little bit helpless if you come out of that without the knowledge or without the money that you thought you would. Gem, where do we start?
So making some assumptions, but I think this person should definitely acknowledge like how far it sounds like they've come a really long way in 3 years from not knowing how to pay a bill to now being ready to invest within 3 years. Like that would have been a really, really difficult time and a steep learning curve. So I think they should be very proud of themselves.
Yeah, absolutely.
like we don't know your situation, so I don't know. You might have a big lump sum to invest and then be adding 500 a month, or we might be starting with zero and adding 500. If we're starting with zero, looking for an ETF and are going to be adding $500 a month, which is a substantial amount, it doesn't warrant financial advice, because that is going to be more than you're going to invest in the first year. And the good thing about ETFs are that there is lots of information. They're diversified. It's a really good place to start, so you don't need an advisor, but your advice fee is going to be not worth it for that zero to build up.
Yep.
But a great place, like I would start with, I'll link it in the show notes, the Rask free ETF
the course. Yeah.
Like I've had so many money coaching clients do that. Podcast episodes on ETFs, and just looking at what the most popular ones are that kind of cover everything, just to dip your toe in something that has everything covered from asset, like different asset classes. And just really diversified so that you can just pick one and get confident with it. Yeah. But that course, that's like
easy.
Perfect
it's the most popular course that we have. So it's the ETF investing course. There's also the ETF investing mini series, Gem, which is a YouTube series that we've done, which is you can just watch it in your own time, and it uses examples of ETFs and how to research them. Another thing, I would actually look back. So these three questions are great because they've got similar elements in all of them. So Newbie Numbnut had a great suggestion for need to be brave, which is this questioner's name. If you've got $500 a month and you're nervous about it, break it up. Don't put it all in one time. Mm-hmm. Go and put $10 in this week, $20 in next week, and just slowly get more familiar. Because I remember when I first invested, ETFs weren't really that interesting or around at the time. And I remember that I just put like some money in, and we didn't have micro investing obviously either, and brokerage was super expensive. So you had to invest more and you had fewer options basically, and it was riskier. Now it's obviously all those things have gone away. I remember when I put money in, I put it into Telstra, NAB, and something else. I can't remember what it was, maybe Woolworths, because that's all I knew. And the first few weeks, I was checking it like every 10 minutes. At the time, I used CMC Markets. I don't anymore. But I was literally just hitting refresh, like multiple times an hour, because I was like, whoa. It was kind of like a digital casino at the time. I was like, refresh, money down, refresh, money up. That's good. Like endorphins were just like,
it's a roller coaster.
Absolutely. And I think everyone kind of goes through that. So once you get used to it, you realize that's not really how the stock market works and not probably what you should do. So start as small as possible and just get maybe the first 3 months under your belt. So just save the $500 in a savings account. Maybe put $100 in this month, $100 next month, $100 a month after, and then reassess.
Just build your confidence. And the other thing that this person, I'm hoping that while they were doing their 3 years of, getting their finances kind of sorted and their knowledge, that they've been engaging with their super and looking at that. But that's a really good way for you to get comfortable with investing, because your superannuation is an investment portfolio and chances are it's invested for you in a mix of asset classes that are broken up, kind of like, a pie. So getting the app, looking at what's happening with that can help you get really confident as well.
Yeah. That's a really, really good story to end on, because starting again, Gemma is constantly writing about this. You're on Instagram, you're on everything, every platform. You've been working on a lot of stuff in the background for this type of thing as well, like not just separation, but just like restarting afresh with finances after change. So you're definitely in the right place. If you're thinking about this, or you know someone that's going through a separation or a massive life event like family members becoming ill, this is the podcast you want to listen to, and you can ask your questions each and every week. It's a very, very incredibly common, and it's a real good reason to get support. Few things I'll take away from this episode. One is, if you know how to find a mortgagee sale in any state or any area, please write into us, because Gemma's come in and dropped a bombshell of like, maybe these things still exist. That was 12 years ago.
That was a while ago.
But maybe they still exist.
Surely. But yeah, I used to hear about them all the time, and now I don't.
It's probably because property prices have gone up consistently, but the moment that they start to falter, people might be selling.
But I'll find that email that I get regularly from the public trustee too.
Yeah. And if you know this, if you're in the game or you've been through this before, write into us. Just use Instagram or use the community or even your podcast player where it's ask a question. You can use that just to submit feedback for the Australian Finance Podcast, because we would be really interested. I would be really interested to know where they are. If you're starting again, there's a lot of opportunity across investing in ETFs, your super, insurance bonds. There are so many things that you can do you probably aren't even aware of. So just stay in touch with the resources, keep that open perspective, and there will be things that come from there.
Yeah. And I think with that, we do talk about separation and divorce a lot. Well, because I talk about it a lot, but also because it's this age group, right? It's happening. But you, regardless of your situation, you can take learnings from that, because these people have had an outside event that has made them have to take action for this. But a lot of people are just going through the motions and need to be taking action even though they haven't gone through this specific event. So these people have a catalyst. The other people need a wake up kind of thing. So listening to stories like this, you don't have to go, oh, well, that doesn't apply because I'm not separated. You could be like, oh, I need to get on top of my bills, and within 3 years, maybe I'll be investing. You don't have to have these kind of devastating events to want to reset your finances.
For our financial planning business, the other day, actually, I was chatting to a wonderful person, and she was like, I've been thinking about seeing a financial advisor for a few years. I spoke to a couple over the last year, and she's like, I just don't know. And I'm like, well, because it was impending retirement, I said, not making a decision means that you are still going to retire, but in this instance, you're not going to have a financial plan. So it's up to you if you see a financial advisor or not. But either way, it's coming.
This is happening.
Yeah. So, if you're at retirement age, don't wait to retire. Don't go to the financial advisor at 64 and 11 months and be like, I'm retiring in 1 month. What can we do? Give them a chance.
I've seen plenty of those clients.
Yeah. And it's also younger people too, buying a first home, marriage, starting a family, all wonderful catalysts, organic, natural catalysts that come in many people's lives, reasons to get financial planning, even if you're doing it yourself. Just put a plan in place. We'll go with that. Jeez, it's been a long day.
We got to get rid of that sweater.
Yes. And, if you're at those other life stages, unfortunately, sometimes it is just forced upon you, and you should get advice. So this has been great, Gem. If you wrote in this week, please send us a note on the Rask websites and we'll organise your free course or a membership. Don't forget the free courses that Gem called out before. We'll put the link in the show notes. And in the meantime, Gemma, I wish you all the best in trying to find another absolute bargain on property. I think that's a good deal for you. And let us know if you do find one. And in the meantime, thanks for joining me.
Thank you. I'll see you next week.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.